TransDigm's investment case can be predicated on three primary tenets. The first is that 80% of their revenue is derived from sole source products. What this means is that they are the only producer of the product. And this affords them strong pricing power and can be evidenced by the fact that their profit margins are twice that of the industry average. The second factor is that there are highly regulated barriers to entry and their product portfolio breadth. The aerospace parts industry has strict certification requirements, and when you combine that with the fact that TransDigm's portfolio consists of over 300,000 parts, it means a competitor will take many years and billions of dollars to replicate their position. And last but not least, thirdly, is that TransDigm have a significant proprietary aftermarket revenue base with multi-decade life cycles. So we at Northstar believe that the margin premium is sustainable and it doesn't represent a risk for three primary reasons that underpin the margin premium. The first reason is that 80% of their revenue is proprietary and sole source, as I mentioned earlier. The second factor is that there's high regulatory barriers to entry, and that acts as an effective deterrent for competitors. And third but not least is that there's significant switching costs created by the criticality and inexpensive nature of the product. For example, their typical customer is an airline, and they tend to prioritize the reliability and quality of the product over the price, given the safety elements involved in flying. The aerospace industry tends to be quite cyclical due to its sensitivity to GDP and airline profitability. However, TransDigm's revenue and profits tend to be more durable through the cycle, given its significant aftermarket revenue relative to peers, which is generally tied to flying hours as opposed to production rates. TransDigm has been a company that we at Northstar have followed for many years. However, its premium valuation has meant that we could never establish a sufficient margin of safety to invest. However, given the growing concern for the outlook in the aerospace sector in the midst of the COVID-19 crisis, TransDigm's share price fell from $650 per share to $250, representing a 50% discount to our base case intrinsic value estimate. Put differently, the enterprise value to operating profit dropped from 24 times all the way down to 12 times, which represents the worst it has been since the global financial crisis, affording us an opportunity to get invested into this high quality compounding company.